I want to welcome back the great Andy Schectman to give us a high-level overview of what's going on in markets and walk through some of today's headlines. Welcome back, Andy.
Elliot, good to see you, my man. Happy, healthy New Year to you and yours. Good to be here and looking forward to doing this throughout 2022, see where this takes us.
Yeah, so the first big headline that we're going to talk about is telling of the times. Obviously, CPI hit 7%, the highest in 40 years. But one interesting take I want to kind of bring up is a tweet by Peter Schiff. The price of goods rose by 10%, the highest since 1975. Real wages fell for the 9th month in a row.
Yeah, well, I think that basically he's saying that there are no adjustments that are keeping up with the cost of living, that prices are, consumer prices are getting out of control. And this is courtesy of the Federal Reserve, and this is not to be surprised when 50% of every dollar ever created in the history of this country has been done so in the last 24 months, last 2 years. That's what we should expect. And even those people that are getting pay raises, they're not keeping up with the increase in the cost of living that. At 0.9% per month, roughly, you're talking 12% increase in the cost of living per year. In other words, the CPI is woefully understating what the real cost of inflation is. And just looking at the month over month and looking at the numbers that John Williams of Shadow Stats talks about, we're probably double the 15%. So wages are definitely not keeping up with the increase in consumer prices. And the question is the Fed going to get tough on inflation, or are they going to sacrifice the dollar and let the markets in their overbloated sense continue to roll? And that's heads you lose, tails you lose. It's a tough position to be in for the Federal Reserve, no question about it.
Yeah, and every time I hear about real wages falling, I think about January 6th and how everyone was just all these working class guys just storming the Capitol. Everyone's just so frustrated because no one's getting anywhere. The American dream isn't as realistic as I guess everyone thinks it should be. So everyone's just really frustrated. So where do you see this kind of leading if people just aren't making enough to get by?
Well, in the environment, you have this dichotomy between people who have something and people who have nothing. It's a K-shaped environment where people who are wealthy have watched their assets increase exponentially over the last 2 years. Stocks and bonds and real estate have all reached all-time highs in this environment, courtesy of the Fed and their easy money and their stimulus that's found its way into assets. There's your real inflation, is in asset prices. But for everybody else who doesn't have assets, they're finding it harder to put food on the table, harder to heat their home, harder to go from point A to point B and filling up their gas tank. The cost of living is becoming exponentially more expensive. If you have assets that have increased by 1 or 2 or 3 times, you don't really care about the increase in the cost of living. It's really inconsequential. If you don't have assets and you're just simply watching it, your grocery bill and your utility bills and your gasoline bill and cost of insurance and cost of tuition, and all of these costs are rising so fast. And if you don't have assets and you're just trying to make ends meet, you're having this environment where it's setting up for a revolution, where you have over half of the country really just struggling to make ends meet, and the other half of the country is realizing all-time valuations in all of the main asset classes in this country, stocks, bonds, and real estate. So I think you see more of this type of environment, and you'll see more of that type of environment, and probably more in Main Street, where people just take to the streets, and you'll see protests, and probably much worse, where people are just going to take to the streets and express their displeasure in an environment where the cost of living is just running away.
Exactly. That's why it's a good time to be discussing all this, because it seems like we're just marching towards the end game of frustration and populism. There's just so much going on. Here's another headline. America draws comparisons with Soviet Union as grocery store shelves go bare. Rising prices wiped out pay increases. Polls show inflation is now a top concern for Americans. I remember hearing from, I think, Jim Rickards saying that no one will be like talking about hyperinflation, but you'll just notice that the store shelves start to go bare. I don't know if this is just a temporary supply chain disruption or if it's more systemic.
I was at Target yesterday, told my wife I couldn't believe the shelves were 30% empty. I've never seen anything like it. It was actually very eerie. And you wonder, is it because there's a lack of workers there? Do they not have enough people to stock the shelves? Or is it something much more, as you say, systemic in nature? Is the supply chain issue that big of a deal where, you know, there are aisles where shelves are 70% bare? As a whole, I would say the store is minimum here in Florida, Delray, 30% understocked from anything I've ever seen walking through a Target in my life. And it was actually kind of eerie and kind of shocking. So I think Jim is probably right. Look, you know, the Fed is stuck right now in a quandary where you have a market that is addicted to stimulus and easy money and low interest rates. And if you pull that away, it's like pulling a needle away from a heroin addict. There will be convulsions. And so the Fed has choices to make. Now, if you look at their December minutes, they talk about 3 rate hikes. And this isn't to be confused with the announcement a few weeks ago that they were going to start tapering. And, you know, up until recently, I don't know that the market really believed that the Fed would follow through. If you look at the December meeting, the December minutes from their meeting, they talk about doubling the speed of their taper. And that isn't even what caught the market off guard. I think what caught the market off guard is that they were talking not only about 2 to 3, maybe even 4 rate hikes, but actually into March and April, stopping asset purchases altogether. And at the same time, they're also talking about selling off their balance sheet, and doing so in a manner much more expedient than the last time they tried it in 2018. When they tried it in 2018, we saw a 20% drop in the S&P. We saw the markets go into convulsions. And we saw that right leading up to the heels of the 2019 repo market. They lowered their balance sheet in 2018 from $4.5 trillion to $3.75 trillion, not even a full $1 trillion. And the market started to really freak out, and they reversed course and then bloated their balance sheet all the way up to $8 trillion, where we are now. So what you have is a unanimous consensus amongst the Fed governors to not only increase or double the speed at which they taper, to stop asset purchases altogether by second quarter, and simultaneously doing all of this, including selling off their balance sheets in a more expedient fashion than they did before. What we saw when this happened is widely known as what's called a taper tantrum. And if they follow through with what they're talking about, getting tough on inflation at the expense of the markets, you will see the exact same thing come second quarter of this year. And the question becomes are they jawboning? Are they just giving lip service to make it seem as though they're going to be tough on the dollar or on inflation and protect the dollar, or at the expense of the markets or not? And part of me believes that they're jawboning, and I'll tell you why. Just look at this month as an example. They talked about paring back their asset purchases, called tapering, to from 130 billion to 115 billion, or something along those lines. They were talking about a 15 billion decrease, but if you look at the actual numbers, they only did 5 billion less this month than the 15 they were talking about. So when when the market believes that the Fed will do something, it starts to react and move in and of its own without the Fed even having to do what they said they're going to do. Just the speak of it, the talking of it, the jawboning of it is enough to get the markets to react. And so if we are to take the Fed at their word, we are on the heels of what could be the beginning of certainly a recession into a depression if they let the markets crater. You have stocks, bonds, and real estate at all-time highs, fully addicted to the monetary stimulus. You pull that needle away, and in fact, not only pull the needle away, but start to sell off the balance sheet, and you're looking at some very tough times in this country. And if not, if they are just jawboning and they let inflation run and protect the markets and protect the wealthy whose assets have doubled and tripled and quadrupled, you're looking at really a further evisceration of the dollar, much higher inflation. And, when we talk about the Fed selling off their bonds, I really have a hard time believing that they will, because who in the hell is going to buy bonds right now, as you said, with the CPI at 7% and the yield on the 10-year Treasury at 1.5%. You're talking a 5.5% real negative rate of return. And so all of these statements by the Fed are not only somewhat difficult to decipher, as they're kind of talking out of both sides of their mouth, but whichever path that they choose really has consequences that I don't know that this country is ready to deal with as far down the road as we are in a situation where asset prices have gotten so high that you can't even decide what the real fair value is. But if rates do rise, Mother Nature will have to revalue those assets to meet the increase in rates. And I think that's something that this country really is not prepared for.
Yeah, absolutely. And hard money economists have been kind of decrying the whole printing of money, the whole lowering of rates, the whole manipulation. And the Fed has had a lot of room over the last 20 years, pretty much since they started this experiment. But now it just seems like the screws are getting tighter and tighter and tighter. They have less and less tools. Do you think that, maybe they'll get like 0.25% rate hike in, and maybe they'll get another, but that might just be it too much, and that might corner the Fed. Do you think at that point, are we getting closer to the point where they just lose control?
Well, think about that. You could argue they already have, if that's the reality of it, a quarter rate point or a half a rate point. That's ridiculous. That's just a token. That's just appeasing the masses, make it look as though that they're getting tough. When I started in this industry, Elliot, interest rates in 1990 on the 10-year Treasury were 9%. So you could put $1 million into a smattering or a laddering of 10-year Treasuries and make $90,000 a year tax-free, never touch your principal. So you put $2 million in and you make $180,000 a year tax-free return, never touching your principal. Now that same investment to make 180,000 would cost 20 million instead of 2. And so, it's an environment where if you talk about raising the federal funds rate to from 0.25% to 1%, give it a 0.75% raise, and you think that will send the markets into convulsions, the only way to really stop inflation is to raise the federal funds rate above the rate of inflation. If the federal funds rate's at 0.25% and the CPI bullshit numbers, which are understated by a half, are at 7, they would have to raise the federal funds rate by over 700 basis points or 7% just to get above their stated rate of inflation and to receive a positive return in buying treasuries. But if we realize that they purposely understated inflation, you'd really have to see rates get above 15% to really start making interest-bearing investments attractive if you understand the situation. And kiss this economy goodbye, put your head between your legs and brace for impact. They can't do it. So what is a 0.25% rate hike? What is a 0.5% rate hike? It's bullshit. It means nothing. And that's why if you look at the way the bond market has reacted to this, the 1 and the 2-year Treasury have reacted, the 10 and the 20 or the 10 and the 30 haven't, because that's exactly what the market thinks will happen, that they'll try to get tough on it for just a little bit. But by the time that they really start seeing any type of meaningful increases, the market will throw up, and the 10 and the 30-year believe that that's what will happen, and they'll reverse course and go the other way altogether. So I guess we'll have to see, are they really going to be tough on it, or is it just more jawboning? And I would have to basically fall back on what this and all previous administrations have done, and they will sacrifice the dollar in favor of the overbloated markets. That is my opinion. They're trying to make us all believe that indeed that they're actually going to get tough on things for once and protect the dollar at the expense of the markets. But I have a hard time believing that's really the road that they will take.
Exactly. And that is our opportunity as investors to front run kind of the news of what the Fed is going to do, because it does seem the market still thinks that they're going to raise 4 times next year, which means that if they don't, then assets like gold will benefit as soon as they realize that, the Fed is trapped. So gold was flat in 2021. So given this kind of scenario, let's say the Federal Reserve does not actually hike 4 times. What do you project to happen to gold in 2022?
First, before I answer that question, which would be about more continued inflation, let's say that they do raise rates and they do hike things and they do pare off their balance sheet and they do get tough and we see the economy slide into a depressionary deflation. Most people talk about the virtues of gold in a inflationary environment. But in a deflationary environment, you could argue it performs better than anything in the world, because in a deflationary depression, counterparty risk comes into question quite a bit, as you see, especially with all the derivatives, the inability of counterparties to perform. Banks and companies are going out of business, and the economy slows, debt increases. Debt repayment becomes next to impossible. Companies go out of business, and you see this systemic chain reaction of counterparty risk. And gold and silver are the only assets that are not simultaneously someone else's liability. So you don't have the counterparty risk when you're holding a gold coin in your hand. Now, you could argue silver may not perform quite as well in that environment, as the industrial applications could be affected in a slowing economy. But even still, in an environment where counterparty risk, I think, will really take on a whole new level of relevance and importance. Having something that doesn't have counterparty risk, that, I think, quite frankly, would be the only place that I would want my money to be in that environment. So whether it be inflation, if they don't raise rates and they don't get tough on inflation, we know what gold and silver have in terms of their virtues for being an inflation hedge. But even if it goes the other way, when everything starts to implode, remember, having something that maintains no counterparty risk really is really very important. So what do I think will happen with gold? Look, I take a step back and I look at the massive acquisition by all of the world's central banks, the Dutch National Bank, the Bank of Austria, Bank of Turkey, Bank of Poland, the German Bundesbank, the Bank of Serbia, the Chinese, the Russians, the Indians. They're all massively, Singapore, all accumulating gold. And could it be because it was reclassified as a riskless asset, as a tier 1 reserve asset? Could it be that they see what's coming and ahead of the masses? I think absolutely. You look at JP Morgan, who, after paying a $920 million fine for manipulating metals, has accumulated 1.1 billion ounces of silver, 11 times what Hunt Brothers tried to buy, and over 35 million ounces of gold. All told, it's the largest position of metals the world's ever seen. So you see the biggest money in the world front running what is coming. Price is a tool of misdirection, Elliot, and we have been misdirected by price as the big money has repositioned out of dollars. So whether it be 6 days or 6 months or 2 years from now, ultimately gold will, I believe, be a whole hell of a lot higher in the face of a dollar that comes into serious headwinds, if you will. And so I don't know what the price will be. I could pick a number and say 3,000, or it would just be a guess. But to simply say, look at what the biggest money in the world is doing and have been for quite some time. They don't care about the price. They have been accumulating gold and silver in a fever pace. And that's another way of saying de-dollarizing. This is not like a speedboat. This is an ocean liner. And it takes a long time to make its move and to turn. But when it does, if you're not positioned properly, good luck in accumulating gold and silver or anything opposite the dollar in that panic environment. The only way that you ever succeed in investing is to be proactive before the move makes itself evident. And I think that's what the biggest money in the world is doing. And I think that bodes well for the price moving forward. But, you know, as the old adage goes, be careful what you wish for, because, you know, as gold and silver rise, that speaks to the falling and the denigration of the US dollar. And I think that is what we have on the horizon.
Yeah, absolutely. And, you know, the sentiment in gold is pretty terrible right now, because it seems like gold, like other assets, people do not want it when it's on sale. But once it goes up, they love to chase gold. I mean, that's just how the herd works. So
that's how the herd works in every investment, right?
Yeah.
Never buy when it's on sale, when you should. Buy after it becomes expensive and everyone's chasing it. Look at Bitcoin. It's a prime example.
Yeah.
So if you look at the way markets move, what is it? 90% of the gain is in the last 10% of the move. So it's because everyone is running. If you talk to my friend Rick Rule, he'll tell you the most money he's ever made ever. And he's one of the most legendary investors in this space ever in the United States. And he'll tell you, he's told me that the biggest money he's ever made is buying assets that are out of favor. You don't chase it when everyone validates it. You reposition into it because you have strong conviction and understand the logic and the mathematics and the economics of it. You position before the herd does. And by the time the herd is running in, you're selling, buy low, sell high, and looking for another asset class that is undervalued. As he often says, if you're not a contrarian, you'll be a victim. So I think this is the time to do it before the public gets it, because not only can you see the writing on the wall based upon the sticky wicket that the Fed is in, but look at what the biggest money in the world has been doing when price hasn't really been going anywhere. They've been using this price to run cover, and the rhetoric that we see to run cover for massive de-dollarization and acquisition.
Absolutely. So if investors want to take advantage of the low price, and a quote just came to my mind, as Jeff Gundlach says, you're either a momentum investor or a value investor. So if you want to find value and maybe buy it while it's on sale, where can people go as CEO of Miles Franklin to buy physical?
Yes, send us an email at info@milesfranklin. Put early stage investor in the subject line. We'll make sure that everyone that comes from you receives the best price in the country. We will send you updated price lists. You'll be contacted by myself or one of our brokers. Our new website will not be done, which will allow online purchasing for probably another 3 months. Until then, we're still old school. We will make sure that your listeners get the very best price in the industry. As an example, we're running specials right now on the Valcambi Kilo Bar at $2.75 an ounce over the price of silver, or the Nadir 10-ounce silver bar at $2.99 over. These will be the best prices in the country, just emblematic of 2 items that we have. But anything your listeners are looking for, info@Miles Franklin, early stage investor in the subject line. Any questions you have in the body, we'll send you an email with questions answered, with an inventory, and be there to answer any questions and assist your listeners in purchases if it comes to that.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.